Let's continue to this now. South African households are feeling the squeeze from high inflation and rising unemployment. This is according to the latest Altron FinTech Household Resilience Index for the first quarter of 2025. The study shows that despite the recent rate cuts, many households are still struggling to make ends meet.
The restrictive monetary policy of the South African Reserve Bank is blamed for the consistent decline in the average disposable income for each South African in real terms. While lower interest rates have brought some sort of relief, households continue to face persistent financial pressures. The index showed an increase of 2.5% on a year-on-year basis in the first quarter of 2025 compared to the GDP growth rate, which remains below 1%. Altron says this is not too bad for households and it is all thanks to lower interest rates. However, economics advisor to Altron FinTech, Dr. Botha, says the MPC is to blame for how the South African economy has turned out.
If I can quote Johan Gellatly, the managing director of Altron FinTech, he has also referred to the fact that there was a 4.2% quarter-on-quarter decline. And as he has said, a far more aggressive rate-cutting cycle is essential to restore household financial stability and stimulate the investment and consumer spending that drives our economy. The South African economy, like most economies, is driven by capital formation and private consumption expenditure. And if your interest rates are too high, then that will not be forthcoming. So, I can share with the viewers and the listeners that I'm involved in a research project right now where we are quantifying the damage inflicted on the economy by the restrictive monetary policies of the Reserve Bank.
This week, the Joint Macroeconomic Standing Committee of National Treasury and the South African Reserve Bank announced that it is in a process of finalizing recommendations on an appropriate inflation target, which is critical to sustaining economic growth. The committee's work comes after an announcement by the Monetary Policy Committee that it preferred inflation to be at the lower end of the range at 3% as opposed to the current 3 to 6% range. The Reserve Bank says the 3 to 6% range is a wide target band and carries challenges as well as long-term costs to the economy. However, Botha says if the Reserve Bank decides to go for a 3% target point, it will result to extremely bad news for the South African economy.
If the Reserve Bank decides to go for a 3% target point, that is going to be extremely bad news for the South African economy. Because we are already seeing, and the research at the Optimum Investment Group shows this, that wage increases are between 4 and 5% over the last couple of months. Administered prices are increasing at almost double-digit rates. So if you look at the composition of the inflation basket, it means that all the other stuff combined needs to only increase by 2%. So effectively, they are making it a lot more difficult if they were to do this, to actually attain such a low interest rate. We must remember that we are not a high-income country. We are not an advanced economy. We are an emerging economy. We are far removed from the lucrative consumer markets in Western Europe and North America. And we need to take that into consideration. We will always, at least for the next couple of decades, have a built-in supply side and exchange rate factor of probably between 1 and 3 percentage points on the inflation rate. So to go for a 3% inflation point, as far as I'm concerned, is ridiculous. We can just stick to the 3 to 6% range and be a little bit more flexible towards the upside, as it was when Jill Marcus was governor of the Reserve Bank.
Looking ahead, Botha says the resilience index can improve in the second quarter if higher employment and lower interest rates are achieved. He says these two things are desperately needed as they work hand in hand. Nothando Makutulela, SABC News, Johannesburg.